Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for the week ending Friday, March 15th, 2019. I should call it an almost closing market wrap. It is almost 3:30 Eastern Time, so we have about another half hour to go. So I want to just go over, do a quick wrap up, what's happened this week, what didn't happen, and some key levels to look at. We're also going to look at a few charts that I haven't covered at least in a while, some long-term charts. So we'll jump all over the place, but again, I don't anticipate this to be very long. Just want to start out first and foremost by saying that today is triple witching. That is, you get that at the end of a quarter. So we're in March, the expiration. You have futures, options on indexes, options on stocks, futures, a lot of options and things expiring on the same day. Triple witching days are notoriously volatile. What I posted on the site a couple times today is don't try to extract any valuable information on what happens today. Some traders will completely stand aside on triple witching days because of the volatility. Here's the SPY, for example. This is a 1-minute chart. So this shows you daybreak line, that yellow dotted line. That's where we closed yesterday. So you can see SPY gap down, and pretty much it's been all over the place today, running, up, down, back and forth. And really we're about back where we started the day yesterday and almost flat. So can't really extract much from today's price action, but and nor can we extract really anything from this week's action. But there are some very important levels and developments I want to talk about, so let's get to that. Let's jump out now to a daily chart and talk what's probably, well, to me, the most important thing right now going on in the market, and that is this key level here. Keep harping on the, we had a virtual triple top high there on SPY. That one fell a little shy, but again, there's a lot of reactions on that level. Big reaction back there, and it is now, if I'm not, we're 19 days into testing that level. So while it seems, and certainly I will give this market credit, extremely resilient. We're not going down. This is the biggest correction that we've had since last December. However, the market's not going up either. What I mean by that is this is the candle right here. We first kissed that level, which again, that's been all year, since the end of last year, my uppermost bounce target for the rally there. Let me put that line right there. So we kissed that on February 25th, and so now we're looking at end of today. That'll be 19 days ago, and so we've had several failures there. So that's certainly, you can't say that's bearish, but it's not bullish either that we're not taking it over now. I'm not taking anything away from this run. So when I say what's happened here isn't bullish, you can spin it that way because the primary trend, at least off the lows on the 24th, is up, and so the market's not going down. We had a correction with pretty impulsive buying sense. So I will give check marks across the board to the bulls for that they contain this pullback at the shallower end of some of the targets where expected it to go. So far it's not over because we're back at those levels. Oh, sorry, I had a distraction there. Anyway, so that's it. 1, 2, 3. That one was pretty big because we had the bearish engulfings on the daily, and that followed with that. Impulsive buying, but again, failure, failure, failure. Stalemate, Mexican standoff, call it what you want. The bulls have not been able to surmount that level. The bears haven't been able to take it down much more than that. So nobody wins, nobody loses. This movie will be continued next week. I don't care what happens in the final 30 minutes of trading. I don't care if we close right here or if we have a big red candle. We're close enough in proximity to that major level that it is anybody's game right now. Let's look at the weekly candles. I'm really harped on those last week, and as I said, we had bearish engulfing candles, which in themselves, again, at least not in my book, are not sell signals. They are potential sell signals. Just like a bullish falling wedge pattern is a potential long entry with a potential, or a potential long trade with an entry pending. But if that pattern never breaks out and you don't have the breakout confirmed with impulsive buying on the breakout of the wedge, then it's not a buy signal. And so in my book, a bearish engulfing candle is confirmed when you get that additional red candle or red candles afterwards. So far, we'll give check marks to the bulls for foiling that pattern. However, they haven't taken it above. They didn't close it. Ideally, I wanted to see it close at or below the middle of the candle. That didn't happen. So let's just say this is a canceled potential signal So we don't have a sell signal yet on that weekly time frame, but again, nor have the bulls been able to either negate that candle by taking and printing a big green close above it this week, or take out that high. So that's where we're at, and sometimes it takes patience in the market. So we'll have to see what happens. Let's look at one thing before we leave these daily chart. No, let me show you what I wanted to look at here real quick. Okay, what I wanted to do is a then and now. Sometimes I like to go back. We don't have a lot of bear markets in recent history to reference, only a few. So let's take a look at the last one. I've already done several videos talking about retracements and other things, but let's talk about where we're at in this cycle. What you're looking at here, this was the top of the last bull market and the entire bear market on this chart right here. So the market peaked back then in October of 2007. So far as of now, it's peaked in October 2018, and it bottomed here in March of 2006. That was a roughly 55% drop in the S&P. But again, the comparisons that I'm looking at, going off the thesis that this may be, a lot of signs point to the fact it could be a bear market rally. I know I'm getting more and more feedback. No, that can't be. It's impossible. Too much. Well, let's just look at the facts here. All right. So there's the initial leg down. When I talk about initial, you had leg down, positive divergence, just like we had recently. Like I was pointing out, going into the December 24th lows, we had the divergence there on the RSI, on SPY, and I believe QQQ. And this was our first, what I call the first primary major kickback rally. And in the S&P 500, it was 15%, 14.8. That's a rough measurement. So 15% rally. The other thing to note, just like we had, I get a lot of every now and then, divergences don't work anymore. And I say this, they play out much, much more often than not. I'd say over 90% of the time, but they're not the be-all, end-all in trading or investing. But what we have here is well, I wanted to highlight it with a different color tool. So you had negative divergence there, and you can see small divergence, a high right here. See that blue line that I'm circling right there? That is from that point right there. Probably shows better with this tool. We had small divergences, and that marked the top of the kickback rally. And from there, that was your last opportunity. If you weren't short here in that bear market or didn't exit your longs, that was it. Because after that, the bottom fell out. We had the big, primary wave 3. It didn't stop here, and then you had a kickback rally. So bear market rallies, as I've said before this one, well before this one even started, if that is what it is, they're extremely powerful. You don't want to be on the wrong side of them. You don't even want to swing trade or trend trade through them, in my opinion. It's something you want to sidestep. And so, again, let's just look at numbers. 15%. Let's look at, let's go to QQQ first, and the NDX back then, and see what happened. Okay, so this is the Nasdaq 100, same thing. This was the top back in 08. This was the bottom. The Nasdaq NDX, remember, it is not really a well-diversified index. Of every index out there, the Dow, the Russell 2000, the small caps, it is the least diversified because it lacks certain key sectors, and it's very top-heavy in tech. However, it's a very tradable index, so it's one of my preferred trading proxies, and a lot of others, because tech is high growth. It goes up more when things are going well, and it goes down faster when things aren't. So there's the top back in 07. Anyways, let's just focus on the initial kickback rally. Remember, we had the first leg down. There's your bullish divergence, time to, divergence down here as well, get long. And we had a 23.5, we'll call that round up, 24% rally. And how did that rally end? Just a little tiny, almost hard to, pick up here, but it's certainly there in the charts. Small divergent high, 24% rally. All right, now let's look at today, and then there's one other thing we want to look at. Okay, that was then. This is now. Here's the top in that we had in October of 2018. I've zoomed in. It's only a one-year chart, so it's not going to look exactly the same, but the numbers are the same. Measured it up, and I'm including where we peaked today, if that's what that was, about 20.5%. We'll call it 21% rally. That compares to a 15% rally, so a little bit stronger. I'm going to get to that point in just a second, but again, still well off the highs. And when you look at it, just from symmetrical, or the symmetry of that move, very similar. And again, what do we have that we had back then? For the first time, now I pointed out divergences in the 60-minute charts going back for months. Each of them played out for a little pullback or a little sideways consolidation, some bigger than others, including the most recent correction we had, but none really played out for much more than that. However, up until this point, as you can see, divergence is defined as prices making higher highs against the indicators making lower highs, and that has not happened. So for the very first time since the market bottom, we now have what I call potential. We'll need to turn back down here. Indicators are pointing up, but comes right around when that other top did in 07. Remember, we had a kickback rally that went into the first or second quarter of 2008, that is. And so far, again, this one's a little stronger. Again, there was 15% compared to about 21% on the S&P 500 here. And now we look at the Nasdaq 100 NDX, again, just for comparison purposes, not the most accurate index to look at. It's been strong again, but it was strong back then. Remember, during a correction, what do people want to buy? They want to buy the leaders, the beloved FANG stocks. So when you have a correction, they led the way up in the previous bull market. They certainly led the way up back then. If you recall, I measured it out at 23.5, so we're going to call that 24% rally back then in 2008. That was off the initial leg down. The first major bear market rally was 24% then. As of today's high, 24.5%. So it's powerful. If you haven't traded, through different market cycles, you're saying there's no way this can be a bear market rally. And guys, it may not prove to be. We need to see some evidence here, and we need to see it soon. A reversal, some bearish technicals start to pan out. But the point I'm trying to make here is this is well within the norm, and there's your divergence as well. We have not had that at all, not even remotely close. You can see the PPO being strong, moving up, and now we have the divergence, and all we need to do is turn down here. So again, we're at a very critical level, and that's that resistance level on the broad market on the S&P 500. And so we'll have to see next week how the market handles that. That kind of in line with the numbers I just showed you. Remember, the SPY or S&P 500 has been a little bit stronger at this point than where it ended its bear market initial kickback, the initial bear market rally, the first one back in 2008. That was 15%. We're at 21 now. Also, when you're trading, when I'm trading a chart pattern, if I'm on a 15-minute chart, I'm trading a bullish chart pattern that maybe it's a wedge and it's relatively small. It's on the 60-minute time frame. I'm looking for a move that might be mid to high single digits, maybe low double digits. But if I'm trading a weekly chart or a bigger, much larger pattern, then I'm looking at much larger price targets in percentage terms. So in other words, everything is relative really to the scope of the move or the scope of the pattern. So let's just quickly talk about that. Here's the last bull market that we had was from 2002 to October 07 right there on the S&P 500. It measured, I've already had the measurements down here. It's probably popping up to the left of my screen, but I'm looking down a piece of paper, make sure I get it right. That was 2002. That was a 102% rally. Again, I have to grab that candle. So we'll call it a 100% rally in SPY, and it was 177% in QQQ. I'll get to that in a second. So there it is, SPY about 100%, just over the S&P 500. This now being one of the largest and longest and most powerful bull market in history, about 333%. Actually, I have 337 when I zeroed it in SPY. So if you think about it that way, this is a much larger pattern. The moves now, and we've already seen that, this drop was more powerful than that first drop in 2007. So we're looking at a much larger pattern with bigger moves in either direction. So you'll expect the next leg down, if it is a bear market, will probably, well, you know what, I can't try to say that was a true meltdown. There were some fundamental things that happened there that I don't foresee happening. I have said this for a long time, whether the next bear market has already started or it doesn't start for another 6 months or 6 years. Right now, I expect this one to be a lot different from the last one. We're much more closely in a Japan, 1980s, late 80s, early 90s, the lost decade of Japan kind of situation. And I think it'll be a long, prolonged, drawn-out bear market. So I just wanted to kind of put in perspective if this rally, at least in the S&P, and really at this point it hasn't been any stronger than that back then in the Nasdaq 100, which we look at that. Here's the numbers on that bear market right here, bull market. So the 02 to 08 07 bull market was about 176%. Let me look down. Did I do that right? Yeah, I have 177 to be exact. And then this bull market so far has been a whopping 642%. So you're going to expect when you zoom in, you know, the trends in this market, when we finally start to get a major corrective wave, in other words, a bear market, a trend reversal, you can expect the moves to probably exceed those that we did back then. But with that being said, right now, call it what you want, we're right on track. Again, this is that last bear market rally. I was using stockcharts.com on the other one, but there's that last bear market rally, which again was 23.5% back in 2008. We're at 24.5 right now. So that's that. And then finally, let's just look at what's happened over the last week, because again, I'm putting a lot of emphasis on this weekly chart. So we'll run through real quick. As I said, you know, QQQ, although it's a very tradable index, is a high beta due to the tech stocks. Let's see what's happened and what hasn't happened. So we have big fat bearish engulfings here, just like we had bearish engulfings here. These are even much larger, which is more ominous. They have not been negated yet. They haven't been confirmed, but they have not been negated at all on anything, on any of the diversified indexes. What I mean by that is we haven't closed a week above them yet. This candle will not close today. As I'm doing the video, we're dumping into the close here. So let's look at just the rest real quick. So there's SPY, of course, QQQ, that one did. This is all FANG stocks. This is all due to the top heavy weighted, overweight, unbalanced nature of QQQ. If you don't believe me, just pull up QQQE, which is the equal weighted index, Nasdaq 100. That candle has not, will not close above last week's candle, as I'm doing this video with 7 minutes to go. The rest of the market, when you look at everything, the mid caps, major sector, big important component of the stock market, not even close. In fact, they're going to close well below halfway under last week's candle. The Dow, I should have covered the Dow, not even close. We're about halfway there on last week's candle, bearish engulfing candle. And then IWM, 2,000 stocks in the small cap universe, same story, halfway below last week's candles. Trend indicators, a lot of things like that. So you know, I want to do this video because I know the market is resilient, but as I said, we're going nowhere recently. You can gauge it from my analysis, the case I'm trying to make where I think we're going. But you know, it's as of now, while it's not going down, it's not going up, and there's still a lot of work for the bulls to do here. Not so much in price, but some key levels to take out, and they can certainly try to pop it next week. You know, brief pop might not do the trick. We have those negative divergences I pointed out on the daily chart. I mentioned this to a member of the site that said, look, Randy, this technical analysis is just not working. The market's not going to go down, and we're gonna take out those levels in the SPY, and then there'll be an explosive rally because that'll be very bullish, you know, something to that effect. And I said this, look, that could very well be the case. And I followed up to say, you know, by all means, that's your expectation. Go long on that breakout. Put a stop there. That's what stops are for, and let it run. You might do great. But I have an almost unwavering policy that I do not chase breakouts to divergent new highs. Here we go. This is a daily chart. Yeah, don't chase breakouts to new highs, which are divergent highs like this. This is the divergence I pointed out on stock charts a minute ago. I'll have to really zoom in here. I'll tighten this up. You can see here. Stock chart shows it a little better. This TC2000, you're going to pull the PPO up, but it's there, and it's there on SPY. It's there on QQQ, and so there's two things: the divergence and the overbought or near overbought readings. We certainly reset the oscillators here. We rolled off that 70 level, but now we punch back up, and we're very close to being overbought again. And so while and I've said this for weeks now, market can go to moon, it can go to the moon without me as far as the index shorts, which by the way are a very small part of my overall portfolio and positioning. We've been focused on commodities, other things like that. Um, but it's been my experience that much more often than not, when you have especially on the daily time frame, forget about the 60-minute, those divergences aren't as, the longer the time frames and go out to a daily, a weekly, the more reliable the divergences tend to be, the less whipsaw signals you get. And so it's been my experience that breakouts that occur with negative divergences while overbought have a considerably higher failure rate. I mean, many times than those that don't. So, the way to look at it, the healthy thing would be a pullback here. Consolidation. Really get these indicators down and work off the overbought conditions, and then come on and build the energy to make a breakout later above that level. That's a breakout that I might very well be interested in trading. This one, it can pop, it can go this high, as long as we still have divergences, and we're going to be oversold. If it happens next week, we're going to hit 70 again soon on the RSI. You can do the math, you can go through your own chart and look what happens when you buy new highs that exceed that 70 level on the RSI. Roaring bull market, a lot happened. This was an unprecedented time back here, but again, go back in time. And more importantly, just think for a second, if this happens to be a bear market, and I've talked about that many times, is that overbought becomes, and if I said oversold, I meant to say overbought before. Overbought tends to become more overbought and stay overbought for an extended period of time in a bull market, where in a bull market oversold is rare. You get usually a one or a double tap like this, one and done. You buy those oversold readings and you are rewarded. That is almost a standalone buy signal right there in a bull market. I like to use it with other metrics, but the point that I'm trying to make is everything flips in reverse. In a bear market, oversold tends to become more oversold and stay oversold for an extended period of time, whereas overbought readings are very fleeting. You get it usually one and done, and that's it. So keep that in mind as well. And that's pretty much it. I really don't see much else worth covering right now. Intraday charts don't mean too much to me, especially with all the noise, as I said, today being OPEX. As I was doing the video, you can see, this is where we've been today. This is why, you don't try to, a couple takeaways from this, if nothing else. I'll end the video here with a little trading tip. Don't take breakouts on OPEX, triple witching. Don't take it on right in front of an FOMC meeting or right afterwards when you see the big pop after the announcement. Stay away from breakouts, and I'm referring to swing trading on earnings and things like that. So this was the market today, gap down, rally back up to almost positive, down again all over the place to close. Look at that, 0.000. That's what they do on OPEX. They run through, clear everybody out. Market makers, I don't know what it is. It's just a lot of position squaring is what it is when those futures and options are expiring. And so at the end of the day today, we went pretty much nowhere. And so, as I said, this movie will have to be continued next week because the SPY, most importantly, had another failed attempt. It's not, you can't say that's bearish because it's not a rejection, but here's today's candle. Yet, for the 19th day, not every day that we've tested it, but since the first test 19 days ago, every attempt, even intraday pops. There's another tip: don't take intraday breakouts if you're trading the daily chart, or maybe take a position, but you have to keep your stops tight and then add to it once you see a solid daily close above. So this is what bulls want to see next week. This is what the bears want to see, especially on a weekly candle. But as of now, it's going to keep everybody guessing. And that's it for me. This has been Randy Finney with Right Side of the Chart. Have a great weekend.